Thank you. All right. Good morning or good afternoon, everybody. My name is Nick Warren, and today we're going to be talking about a really exciting topic, taxes. April 18th is right around the corner, and many of you are getting your taxes ready. Now, if you're just want to mention that this training that we're going to be doing today is designed for people that are business owners. So if you're a business owner, you're going to love this because we're going to help you learn how to review your tax return, catch the most common errors that CPAs make when preparing business returns for business owners, personal returns for business owners. Now, if you're not a business owner, don't panic. You're still going to get a lot out of this. It's just that wanted you to know ahead of time that we are biased today towards business owners and people that have been in the Jane community that are using their tools. The other thing I want to mention is that today we're going to be talking about how to work with your CPA. Now, not all of you will have a CPA, and that's okay. If you don't have a CPA, then just replace the CPA with your own name. Okay, so that'll help you out a little bit. All right, so first, a quick introduction about me. I'm a first-generation entrepreneur, and I work at a company called Ark Financial. I'm actually a coach. What we do is we help business owners to take control of their finances, especially how to work within the context of their business and take care of their family. I've been a first generation entrepreneur for a long time. I spent about 20 years, the first part of my professional career in corporate America as a business manager, mostly in high tech. And then I started 3 companies and 2 of them are still active today. So I've had some experience exiting a business. I'm kind of a finance geek. In fact, you'll get the feel for that today. Things like taxes actually get me excited, which is weird. I live in Austin and I have 3 kids. And a little bit more about me, I'm big into sailing and Pilates, big into nature. I also big into my family as well. So I am a professional coach. So currently I take care of about 105 entrepreneurial families right now and coach them through things like tax returns, things like how to mitigate taxes, things like how to stay out of trouble and how to structure entities and things like that. So today let's jump in and start talking about the tax year. Now, this is the business owner's tax year. And the thing is, I'm going to share some things with you today that you can't learn in school. And in fact, your CPA might not even think of telling you. In fact, it's really hard to get this kind of content. So let's start off kind of talking about what the tax year looks like from a business owner's perspective. The tax year is not a one-time event in April. And if you view your taxes as just a one-time thing that you do in March and April, then actually you're probably going to be missing out on some things and you're probably creating a little bit more hardship for yourself than maybe you could do otherwise. Taxes are a year-round thing that you do. So let's kind of walk you through this, okay? In January, when we start the calendar year, we first start by doing a little bit of planning. We're certainly wrapping up the previous year. Many of you are closing out your books, you're settling out your accounts, things like that. But this is where you start to think about what do you want to do in the coming year with your taxes. And most of this is around tax mitigation. When we say tax mitigation, that is, how do you lower your taxes? How do you get your tax bill lower? It's also when you start collecting the documents that your CPA needs or that you personally need in order to prepare your taxes. Another thing that happens in January, and this sneaks up on everybody, around middle of January, you actually owe a quarterly estimated tax payment. If you look at the slide up above, you'll see that there's these green little diamonds. Well, that's when your quarterly estimated tax payments are due. And if you're a business owner, you need to be making quarterly estimated tax payments. So the first one's due actually January 17th. And that's going to cover your tax liability for the previous Q4, which is going to be October, November, December. And then we get moving through the year, April rolls around. And so many people file their taxes in April, but you may not realize in March, if you're an S Corp or a partnership, in March, your tax return for your business is due. The business return is due a month before your personal return. A lot of people think the tax deadline is April 18th. And that's because most people in the United States are not business owners. And so for them, their personal return is due on April the 18th or April. It depends on the Mondays and when the holidays fall. This year, it's on Tuesday the 18th. It's usually the 15th, but the 15th this year fell on either a Friday or a Saturday. And so the IRS pushed it to the next business day. So April 18th, your taxes are due, your personal taxes. Now, on April 18th, also due, which is crazy, your Q1 estimated tax payment is also due. So not only do you have to pay your personal taxes, you have to pay your Q1 taxes. So that's kind of a double whammy. And a lot of business owners don't understand that they have to pay the quarterly payments, but then in April, they've got to true up. And then if you keep going through the rest of the year, you can see there's another diamond in June. That's when another quarterly estimated tax payment is due. And then September, they're due. A lot of people file extensions. If you file an extension in March or April, all that's doing is adding 6 months onto the deadline for taxes. So if your business return is due March 15th and you file a tax return, if you add 6 months to it, that brings you to September the 15th. Same thing in April. If the taxes were due April 15th, this year I mentioned they're due the 18th, and you add 6 months to it, then they're due October the 18th. So that's why towards the end of the year it gets busy. And then November, December, we pick up all of our end of year tax planning. And that's the time that you have to do all the things as a business owner to do to reduce your taxes for the year. A lot of that takes place out in November and December. So this is the tax calendar. And you need to understand that taxes are not just a one-time event in April, like I mentioned, that they actually go for the entire year. Now let's talk about extensions for a minute. The question about extension comes up all the time, and you may not understand what an extension is. All it does is it adds 6 months to when your taxes are due. But you may not want to file for an extension. Well, let's talk about why you would or why you wouldn't. The first thing is that you might want to file your taxes on time. The reason you might want to do that is maybe you need to get your tax return done. Maybe the bank needs a copy of it because you're trying to get a loan, or you're trying to buy another business, you're trying to buy a building, so you want to get your taxes done. Also, if you're getting money back, the IRS won't give you your money back until you actually file. So if you file an extension, if you think you're getting money back and you file an extension and it turns out that you're getting a big amount of money back, but you don't actually submit the paperwork till October, you have to go from April till October to wait to get your money back. And who wants to wait to get your money back? There's some pros and cons for filing an extension. Let's walk through them in a little bit of detail, because this is going to dovetail into our next topic about how to work with your CPA to do your taxes most effectively. So just so you know, there's nothing that causes you to increase your audit chances or anything like that if you file an extension. If you file an extension, all you're doing is saying you want more time to prepare your documents. If you do this and you have a CPA, you're going to be making your CPA very happy. Just think about this. Your CPA probably has 1,000 clients. Your CPA is busy getting tax returns done. And then you say, you know, I'm willing to wait 6 months to do my tax return. That's one person less your CPA has to worry about. So one nice thing about filing your extension is actually lets you take more time, and it lets your CPA take more time to prepare the documents, which means they're not working until 11:30 at night to get your taxes done. They can work at a more reasonable pace. In addition, I'm going to show you what a normal review process looks like for your tax return. But if you ask for more time by filing an extension, you actually have time to do all the reviews you need to do. You know, I can almost promise you, if you just try to cram everything in at the last minute, April 17th, it's going to cause a lot of problems. Now, there are some other cons that I want to mention about filing an extension for your taxes. The first is that even if you file an extension, which means your taxes are due in October, you still have to true up in April. That means you have to make an estimated tax payment. You don't know exactly what the number is. You ask your CPA and they can give you an estimate, but that gets you still have to make a payment. It gets you trued up through April, but then you're going to finish the true up in October. The other con, honestly, of filing an extension is that it lets you procrastinate more. It depends on how organized you are as a human being. If you tend to be able to get stuff done and you have the self-discipline to stay on track, then filing an extension is not a big deal. It just means you want to get started a little bit later. If you tend to procrastinate and you file an extension, it probably will mean that you're just going to procrastinate getting started, which means you're just pushing the inevitable off until October. The most effective way to file your taxes is not to rush. It's to treat the tax filing like a little project that you are doing on the same team as your CPA. Now, let me let the cat out of the bag here for a minute. Your CPA, when they do your tax return, they're actually, if you read the fine print on the CPA's service contract, the little agreement that you signed, your CPA isn't actually promising that your taxes are correct. What they're promising that they will fill out the forms to the best of their abilities. You are responsible to make sure that your taxes are correct. Your CPA can't take the heat for that. So you have to approach your CPA like they're a team member, to work collaboratively with them. So for example, if your approach to filing your taxes looks like this, you're just asking for trouble. The way that this works, asking for trouble, is your CPA sends you a list of what you need. You wait, you wait, you wait, you procrastinate. And in April, you're like, oh my gosh, my taxes are due. And you send all the documents over. And the day before, your CPA sends you your tax return. And you sign it and you file it. If you do that, I can almost promise you that you overpaid your taxes or something was missed, because this is not the right way that a business owner should file their taxes. So I want to spend some time explaining a little bit more about what it should look like to file taxes in a more controlled and peaceful way. Okay, don't do it this way. I'm going to show you the right way to do it. If you think of your tax filing as a little mini project plan, then what that's going to let you do is work collaboratively with your CPA. Not only does it reduce your stress level and the stress level of your CPA, but it actually catches more problems. Okay, so your CPA is an advisor to you. They're not filing your taxes for you. They're preparing the forms. It's your job to make sure that they're complete. So there's kind of like 6 or 7 steps to a good project plan. And you might think that this is a lot of work, but actually in the end, it ends up being less work. It's kind of like asking an architect to design and build a house for you. If you just show up after you've dumped all your requirements on the architect and walk through the house, it's probably not going to be right. Same thing with a CPA. So it starts off with a plan, and I'm going to show you a plan, what a plan looks like, and help you get the documents to plan well. Then you're going to gather the documents that you and your CPA have agreed upon that you need. Then your CPA is going to draft the return. They're going to then review the draft with you, and it's going to be a back and forth collaborative thing. You're going to finalize your tax return, and then you're going to file. So I want to unpack this a little bit more so that we can go through this in detail. And then I'm going to pause after this, and I'm going to give you a chance to ask a few questions through chat. And I'm also going to show you how to review your tax return in the review stage. So this is the basic plan. Let's break this down. So the first thing is you need a plan. So the first thing that a good business owner will do with their CPA is they'll have a meeting. Generally, it's going to be in December or February, where you sit down and you communicate what's different in your business. Because your CPA can't read your mind, you really have no way of communicating. Your CPA doesn't know what's changed, and they may not know what questions to ask. And remember, your CPA, if you're working with a CPA that's preparing your tax return, how many other clients do they have? A typical CPA has between 1,000 and 1,500 clients. Okay, that's a lot of people to keep track of. Smaller CPAs may have only 500 to 1,000 clients. So you're one of 1,000 people. Your CPA needs to have clear communication with you about what's changed. They can help you think about what documents you need to prepare and capture. When we say prepare, what that means is you got to download them off a website or take a picture of them or keep a piece of paper in a folder that you're going to provide these documents to your CPA. And then the other thing you want to do is you want to talk with your CPA about the timelines. We're going to break this down a little bit more. Now, when we say the planning step, what we're going to talk about here is the 2 things that go into the plan. The first is to communicate what's changed since the last time you talked with your CPA. Okay, you probably don't talk to your CPA every week, maybe not even every month. So what you need to do is communicate with them what's changed in your business. Have you bought a partner out? Have you bought some equipment? Did you buy another business? Are you no longer renting your facility? Did you buy the building? These are things that you need to say. You need to tell your CPA about. Now, I want to highlight something that you're looking at the slide. Hopefully you're on a computer or a desktop or a laptop or an iPad. Here's the deal. Anytime you see a little QR screen on the code, you can hold your phone up to it and you can take a picture of it. And there's a way to get the download that I'm referring to on the slide. Now, these downloads, we want to make sure that they're for people that are in the Jane community. So you're going to need to give us an email address and your name so we can make sure you're legit. But if you want to download the typical documents that a CPA is going to require from a business owner, hit that QR code. And we'll also, I'm sorry, I said download, but what they're going to do is we need to get your information, then we need to make sure that you're actually in the Jane community, then we'll email you these documents. So we have a tax document checklist, which contains a list of the most common documents that a business owner needs to prepare, and then a tax filing mini project. Basically, it walks through all the tasks that you need to do and your CPA needs to do to prepare a filing. We're going to talk through those things in a little bit more detail. So that's what those little QR codes on the screen mean. Just hold your phone up to it and take a picture and you'll be fine. The document lists shown on the right of the screen are the most common documents that a business owner needs. You need to prepare information about your business. Now, most of you have already done this because this was due in March, unless you filed an extension. But for your personal return, you're going to need the things on the bottom. Your CPA needs those documents. And if you forget to provide a document to your CPA may know to ask you about it because they needed it last year, but they might not know to ask you if it's new. So let's say, for example, a K1. A K1 is a report, is a form you get when you get income from a business. Maybe you went into business with one of your friends and now you have a new source of income. Your CPA won't know about that K1 unless you send it to them and tell them about it. So that's why we have a list of the most common documents and the project plans. So if you request those documents, we'll provide you the list of the most common documents in the project plan, and there's a place at the top for you to indicate for your CPA what's different and what's changed. So this is the first step. I'm going to just take a breath for a minute and see if there's any questions that anyone wants to put in the chat about the planning step before I go on. I don't see anybody typing, so I'm going to go to the next slide. Feel free to put the questions in there anytime and I'll try to address them as I go. So after you finish the planning step, the next thing is you're going to gather documents. Now, I don't know how you're going to do it with your CPA, but I'll tell you, my CPA gives me a website that I can log into where I can upload PDFs. That's the most common thing. But not every tax form that I get is a PDF. Sometimes they're paper. So what I do is on my phone, I have a real nice little app that I can make PDFs. And what I do is I take the PDF, I make the PDF, and I upload it to my CPA's website. I also keep a copy of it for myself. So I've moved completely to PDFs away from paper because I don't like keeping paper files, and you're supposed to keep your documents from your returns. So what you want to do is once you've agreed on the list of documents with your CPA, and you may have already agreed on this with them, or they may have given you a list, you want to make sure you upload all the documents. Now, here's a little hint. Your CPA is working on a lot of people's tax returns. If you're missing a document, what do you think your CPA is going to do when they get to that part where they need those numbers and they can't find the document? They're probably going to send you an email. What's going to happen is they're going to move on to their next client to work on that next return, which means you just got bumped down in the list. What you don't want to do is have your CPA send you your tax return the day before taxes are due. You will need some time to review it to make sure there aren't any errors. So if you miss a document, what typically happens is the CPA is going to bump you down in their priority queue. They're going to send you an email. They're going to move on to the next person, especially right now because they're so busy. So you want to double check when you upload all your documents that you do not miss one. In addition, you want to name the files in a way that makes it easy for your CPA. Here's why. Not every CPA has software that can go and scrape all the files and make sure that you've uploaded everything you need. Some CPA software can automatically read the PDFs. Most CPA software, they actually have to figure out what you uploaded. And so that takes them time. So are they going to spend an hour trying to figure out what files you uploaded or what forms you included? It's too much work. The easier you make it for your CPA, the better that it'll go. Again, you need to think of your CPA as a team member, not as somebody who's just doing work for you that's going to throw it over the wall and then you move forward. So after you've gathered your documents, then you send an email to your CPA saying, I'm all done. I think I got everything uploaded. Can you double check on it? And then the next step after that, I see that someone asked me a question. Hey, if you have questions and you are an anonymous attendee, do you mind putting it up into the chat for everybody to see? The question was, can you name the PDF that you use, the PDF document I use? What I do is I have a list, that's maybe two questions. I'm not sure what you're asking. So the answer is, when I use my phone to take a picture of a document to convert it to PDF, I always use the same format for the file name. I put form, F-O-R-M, and then the form number, and then I put a dash, tax year 2022. That's usually the style I use. Now, I have kids, and so I sometimes have to put my kid's name on it. Maybe it's their bank account. And so I just always start the file with the word form, F-O-R-M, and then the number. When you get the documents from your bank and from your W-2, you could just put the form number on that's in the upper corner. As far as the application I use on my phone to create PDFs, I just use Adobe. I have Adobe Acrobat. I've paid for the full version of that, and I get an iPhone app as part of that to create PDFs. There are a bunch of PDF distillers out there. I'm going to put that word up in our chat. It's called a PDF distiller, and that's what makes the file that then you can upload. Thanks for the question. All right, moving along then for the next step, draft the return. This is what your CPA does. Now, you would think that your CPA gets it perfect the first time. You would hope and you'd pray for that, but that doesn't necessarily mean that's the way it works. So what's typical is that they're going to send you a draft for the return. And what you want to do is you want to hold your CPA to the schedule. Here's why. I don't start filing my taxes until June 1st. Why do I start June 1st? Well, first, I file an extension in April, and my CPA files an extension for me. But what happens after April? My CPA is exhausted. They want to go on a vacation. Okay, so all through April and halfway through May, they go on vacation. And then they come back. I don't want to hit them right away with work to do. So what I do is I start my project plan on June 1st. That means all my documents are uploaded by like June 15th. They've reviewed all my documents by June 20th, which means by the first week of July is when I actually expect my draft to be available. In the follow-up email after this training, there's going to be a link to download the forms that we've already passed on the slide. Plus, as Destin mentioned, it will be recorded. You can go back and get the QR codes. But that project plan lays out when you start and kind of reasonable milestones for a typical CPA. I hold my CPA to the schedule. So let's say that my first draft is due to be emailed to me on July 10th. On July the 11th, if I don't have an email from my CPA, I'm picking up the phone and calling them. And that's because I want to let them know that I care. Most clients that your CPA works with, they don't call your CPA up and ask questions or expect everything to be on time. So it doesn't always help if you let them slip past the deadline. What you want to do is call them and let them know that you care, that you want them to respond to you. So hold their feet to the fire on those schedules. Okay, now the next step in the process is your CPA has sent you a draft. Now, reviewing the draft is a team sport. And I want to show you in a minute how to review a tax return. It's really valuable that you know what to look for and you know the most common mistakes, but it's not all on you. You've got to go and ask your CPA questions about the numbers. Now, don't yell at your CPA. Don't be ugly. They're human beings too. At least I've heard rumors that CPAs are human beings. So what you want to do is when you see something on your tax return that I'm going to show you that looks wrong, don't assume your CPA has made a mistake. Instead, go in with the posture that you believe that you don't understand properly. So first seek understanding. Then if you think there was a mistake, then point out, no, I think that this might be a mistake. Here's some of the things that lead me to believe that. What do you think? So you want to be very collaborative. And I'm going to show you what to look for. So how do you review your draft? So your CPA has finished preparing all your drafts. They're now going to send you this document. And I'm going to teach you how to review your personal tax return. Okay. Now, by the way, I want to mention, if you've already filed your taxes for the year 2022, if you're ahead of most people, that's great. You still want to watch this because you still want to review your tax return. Maybe you didn't do it when it came to you. If you didn't review your tax return, you definitely want to review it because you can always amend it if there's a mistake. All right, so this is what happens. Your CPA emails you a PDF. You open it up and it's 100 pages long. Oh my God, what do you do about that? First of all, it's overwhelming, right? You're like, and of course it's small font. You have no idea what you're looking at. You're like, yes, 100 pages of tax bliss. Doesn't that sound great? And this is not just for nerds like me. So let's just kind of peel the onion here a little bit. What exactly is that 100 pages? Well, it turns out it's not actually all that interesting, those 100 pages. The first part of that 100 pages is usually a letter that says, thanks for letting us be your CPA. Sometimes immediately following that, there's like a little report that shows year over year because your CPA wants to give you a nice little summary. That's kind of cool. After that, usually is going to be a couple of other little reports about how to make those quarterly estimated tax payments that I mentioned earlier. And by the way, as a business owner, I just want to mention that when I started my first business 7 years ago, I didn't think I needed to make quarterly estimated tax payments. I mean, I was getting a paycheck and I was paying my federal taxes. I had set up my withholdings the right way, but I was an S Corp. And as an S Corp, the profits of the business are taxed by the owner. And I didn't understand that. So if you are a sole proprietorship, partnership, an S Corp, or any kind of pass-through entity, you need to be making quarterly estimated tax payments. If you don't, then you're going to get tax penalties. Now, do you care about tax penalties? Hold on just a second. Excuse me, had a little cough. Do you care about missing estimated tax payments and the tax penalties? Well, let me just mention that 3 years ago, nobody cared. The penalties were really small. Tax penalties are based on the federal interest rate plus 3 points. Well, back then, the federal interest rates were so small, nobody cared about tax penalties. They were small. But have you looked at the federal tax rate recently? It's not small anymore. It's like 6.75%. That means you add 3 to that number, which means your tax penalties are like 9% annual percentage rate. It's no longer small. So the way you avoid tax penalties is you make quarterly estimated tax payments. If you're not doing that, you need to talk to your CPA about how to do it. And that's actually the third section of this big PDF tax package, is how to do quarterly estimated tax payments. Shortly after that, on your personal return, you're going to find Form 1040. That's the place where your personal tax return is. It's 2 pages. That's it. Of the 100 pages in this list, you probably care about 2 of them. The rest of them are either these letters and these reports and these statements and schedules and worksheets. The federal government likes to make a bunch of different names for worksheets. That's all they are. They're worksheets. This is one of those tests where you have to show your work. And so your CPA is going to include all these statements, all these schedules, all these worksheets to show your work. That's incredibly helpful also, that maybe next year you're not using the same CPA. You're going with a new CPA where you're going to want to send them last year's tax return. And when you do that, they're going to look at all those statements and those worksheets. We don't need to review that stuff. We need to review the 2 pages that are Form 1040. So let's look into those a little bit more. What is that Form 1040 and how does it work? Well, let me just tell you, Form 1040 is 2 pages and there's only 7 sections. It's not that scary and it's not that complicated. Here's how they break down. You can kind of see through the light blue on the screen. You can see how they're broken down. The first page, the top half, is your personal information. This has got stuff on it like your name, your social security number, your address, your spouse's name, your kids' names. This is easy stuff. So don't freak out about the first section. The next section below that is your income. It's all the ways that you earned money. After your income is your deductions. And we're gonna be looking at these in more detail, so don't get ahead of me here. The deductions are all the things that lower your taxable income. Those are called deductions. After you calculate your taxable income, which is the bottom of the first sheet, it's line 15. That's your total taxable income. The top of page 2 in the upper right-hand corner is the tax due. There's the whole tax due section, but that whole section is just how much you owe in taxes. And then odds are you've already paid some of your taxes, either through your paycheck or doing the quarterly estimated tax payments that I told you about. You may also have credits from previous years. Those are all just payments. So the next section under tax due is, okay, here's how much you've already paid. And guess what happens? You take your tax due, minus your payments, and it's the balance due. That's it. Easy peasy. And then the final thing at the bottom here, see, signatures. Yay, you get to sign it. And your CPA gets to sign it down here. These lines here at the bottom. By the way, your CPA is signing, saying that they have prepared the tax return, not that it's correct. Only you can say that your tax return is correct. So before I go on, let me just pause for a minute. Take a deep breath. We're going to dive into each one of these sections a little bit more detail, but I want to see if there's any questions that anyone wants to put in the chat. Nope. All right. I don't see any typing. Okay, deep breath. Now we're going to talk about the sections, and we're going to talk about the most common mistakes that CPAs make. You ready? All right, let's go. Let's go. Oh, sorry, before I do, I forgot to mention, there are a couple of additional pages in the statements that may be of interest to you that the 1040 refers to. It's in that last section about the statements and the worksheets. It's Schedule A, Schedule C, and Schedule E. Again, they're just worksheets. I'm going to give you a brief summary of them, and you'll realize that they're really not that complicated. Schedule A is a fancy list of all the charities that you gave money to and any other places that you get to take deductions. Like, for example, maybe you have kids, Some states have income tax that you get to deduct. Schedule A is just a fancy list of all the deductions that you get to take. Now, remember, deductions, you get to take them off of your income. So that's Schedule A. It's just a fancy list. You can either make a fancy list, or you can take the standard deduction, which if you're married, finally jointly, is $25,900. You make your fancy list, your CPA makes the fancy list, you add the numbers up. If it's above 25,900, then you take the fancy list deduction. Otherwise, you take 25,900. That's how it works. It's drop dead easy. Schedule C is where your income is reported if you are a sole proprietorship or a partnership, mostly sole proprietorship though. That is just a P&L. Now, the IRS has a format that they want your P&L put in, so you got to fill out the form, but it's just a P&L. Again, very simple. You should know your P&L. Schedule E is where your rental income, your S Corp and partnerships are reported. Again, it's just a simple P&L, except there's 3 columns. That's it. Okay, so these schedules support the Schedule 1040 or the Form 1040, but they're not complicated. You can review them. You can look at the numbers and know if they're right. I mean, you know about how much money you made last year, right? If you're a sole proprietorship and let's say you run a massage parlor and you're the only one in there and you get all the income, you're going to be on Schedule C. You know how much money you made last year. You've got books. That's going to be the top line of Schedule C. You know your expenses. That's going to be some other box on Schedule C. And they add up, they subtract. Your CPA is going to fill this out for you, but you can look at it yourself as well. And if you want to use TurboTax or something like that, that's fine too. After you print out the forms, just look it over and make sure the numbers look right to you. All right, so those are those other schedules. Now back to the 1040. I don't know about you guys, but I measure work that I have to do, especially stuff like reviewing tax returns. I know it sounds really exciting, but it's really not that exciting to me on Saturday morning. So what I do is I measure how long it takes me to do my financial tasks by the number of cups of coffee I have to drink to get through the work. Okay, that's just me. I like coffee in the morning. This is a 2-cup work. What that means is that you will finish 2 hot cups of coffee in the time it takes you to review your tax return. Now, just so you know, it takes me about 10 minutes to drink a good cup of coffee on Saturday morning. So reviewing your tax return is going to take you probably about 20 minutes. Now, here's the best part. You might think of your tax return as a task that you have to do, but it turns out most errors made on the tax return are actually in your favor, which means if you catch the error, your taxes actually go down. So if you review your tax return, there's probably a good return on investment for the 20 minutes that you're going to spend on it. Even if you've already filed your tax return, go back and review it because chances are good that if there was a mistake, it was in your favor. So you want to go back and review that stuff. And once you get in the habit of doing this, it'll become a lot easier. The first time you do your tax return review, you're like, oh, this is how it works. I get it. I remember all that stuff Nick talked about. And then when you do it next year, it might be a little rusty, but the rust falls off very quickly and you say, yeah, I remember how this works. So, all right, so let's talk about the first section, about you. Okay, this is easy stuff. You want to make sure your name's spelled correctly. The hardest part about this is you want to look for typos. Now, what the most common error here is if you have a new CPA this year. If you're using the same CPA as last year, their software remembers you. And so if the data was right last year and you're using the same CPA, it's going to be right this year too. Now, if you change CPAs and you sent them your old tax return, which is very normal, they had to retype everything. Anytime they had to type something, there's a chance of an error. So you're looking for typos. Just so you know, one time I switched the last 2 numbers on one of my kids' social security number. It was a mess because the IRS accepted my filing. And then 3 weeks later, I got a letter from the IRS, and nobody likes getting letters, but I was frightened by it. And it was just simply because of a typo. It's actually more common than you think. So just check all these numbers, check all these things and make sure that your typos are correct. Or there's no typos. Does anyone remember the next section? Next section, remember, it's income. So here's where you get to report all the money you made, which is great. So what you want to do is to make sure that your CPA or you included all your W-2s. Remember, the W-2s are the things that show how much you earned in your paycheck. You want to make sure you got all of them. If you're like me, my wife works. She works at a different company than I do. So she gets her own W-2 and I get a W-2. but then I get paid by 2 different businesses. So we actually have 3 W-2s. It's insane. You also want to make sure that you are counting all the income from all of your businesses. Here's a little tip. When you're working with your CPA, create an entity chart. Do you know what an entity chart looks like? It shows you all the businesses that you own. And maybe you only own one business, which is fine, but you still want to create an entity chart so your CPA knows how many K1s you should expect to have. So the more clarity you can bring things to your CPA, the more likely your tax return is going to be accurate. So when you're filling out the income section, you can just simply add up all your W-2s, add up your K1s, and then you also need to report to your CPA things like the interest from your bank account, if you sold any stock, or maybe you sold some crypto and things like that. That's all going to be in the income section. So again, the most common mistakes here are that you forgot to tell your CPA about a business that you bought or a business you sold. So an entity chart can really clear that up. Second, most common errors, if you make more than about $350,000 a year, a common error we see is if you own your building, your CPA misclassifies your building. That's a common mistake and only applies to people that own their buildings. Next thing that's very common is that if you have a new CPA, they forgot to include a carryover from the previous year. The reason why this is a common error is that there's no one place on the tax return for capturing your returns. There's actually a bunch of fields where that could be captured. And if you're moving to a new CPA, that assumes that they went back and they combed through your last year's tax return. And sometimes they didn't take time to do that slowly enough. And so they missed a carryover. Now, how would you know if you have a carryover? Well, it's hard to know. You have to kind of keep track of this yourself. You just have to know it. Your CPA told you that you had a carryover and you remember it. This is why it's important to take notes when your CPA tells you stuff like that, so that you can pass that on to the next CPA if needed. You can also look at your tax return. There's a couple of places on the second page where carryovers are recorded. The other mistake that we see is common, that is, if you are a business owner and you bought and sold stock on the stock market, maybe through investments, your CPA had the wrong cost basis for those stock investments. What you need to do is get the 1099 that your broker or your bank provides and make sure your CPA has that. That's going to be the way that they know that the cost basis is correct. If you forgot to include one of the pages on the 1099, then your CPA is going to assume that you had a 0 cost basis. And what you're going to do is it's going to cause you to overpay your taxes. So you want to make sure your CPA gets all the forms for all the 1099s that you collect. So once we have your income, then we calculate your deductions. This is where you may have Schedule A attached if you're going to make the big list. Maybe not. If you are a pass-through entity, which means you're an S Corp, a partnership, one of those two, then you expect to receive what's called a QBI deduction. That's in box 13. That should have a number in it if you are an S Corp or a partnership. If you're not one of those entity types, then box 13 might be blank. This is a tax code that was passed in 2017 by the Trump administration for the Job Act's tax cuts. It's designed to benefit small businesses to help them pay less in taxes, but it only applies if you're an S Corp or a partnership. If you're a sole proprietorship, then you don't get the benefit of that tax deduction. But this is where you can look to see if box 13 is blank and you think that you should get this tax deduction. You want to ask your CPA. The way to, again, to ask it is to assume that your CPA got it right, but just ask for clarification. Hey, am I eligible for box 13? I attended this training and this guy talked about the QBI deduction. Do I get that? You want to ask that. Also, depending on the state you live, there are certain states that offer pass-through entity tax deductions. You have to know how to get those, or your CPA has to help you. If you're a sole proprietorship and you haven't talked to a CPA, then you're probably not going to know how to get that tax deduction. But your state income taxes are actually tax deductible in most states. You have to talk to a CPA about how to figure out how to get those deductions. The other thing is that maybe you made a big gift to a charity and you forgot to tell your CPA about it. That's also very common. So those deductions, you want to look through them to make sure that everything is there that you think should be there. If you're not sure, look at last year's tax return. That's always a good way to do it. So that's the deduction section of the most common mistakes. Now let's move on to taxes due. Now, this is kind of a mysterious section, and I want to spend a few minutes teaching you how taxes are calculated. I know this sounds crazy to teach this, but if you understand this concept, then you can get a much better understanding of how to save on your taxes. And when people say certain things, you may not understand what they mean. So the taxes due is just calculated by the software, either TurboTax or by your CPA. It's not probably going to make a mistake, so you don't need to verify the numbers. But I want to teach you how the numbers work, how tax tables work, because this is very unique in the United States for how we calculate taxes, and it can lead to an understanding that can help you communicate better with other people that help support you in your business. So the way it works is that we use these things called tax brackets. A tax bracket is just a table, you can see it on the screen there, where depending on the range of income, there's different tax rates. So let's use an example. So the lowest tax bracket is 10%. If you are a married filing jointly, so we're looking at the second column. If you are married filing jointly or qualified surviving spouse, let's just assume you're married filing jointly, you're in the second column, and you earn between $0 and $20,550, you pay 10% of the money that you earned in that range. Now, if you earn more than that range, then you have filled that bracket and you have to pay the 10% on that range. So let's look at it. Let me say the next row to clarify this. So let's say that you earned $83,500. So the first bracket, you had to pay 10% on the first $20,550 if you're married filing jointly. Then you take the $83,550 minus $20,550, and you owe 12% taxes on that next level, which they call a bracket. So let's use an example. I'm going to actually put an example on the screen of somebody that earns $350,000 last year, and they're married filing jointly. Okay, on the left side, I've put that tax, I've snipped out that second column next to the tax rate. And then I've put little numbers on the screen that I'm going to walk you through this. And I'm going to go slow, and I expect to see questions in the chat about this, so that if you don't understand, I want you to ask me, because this is actually really valuable training. Step one, look at bubble number one. This is a married couple where their total household income was $350,000. We're going to calculate the taxes for them. Okay, look at bubble number two. The first tax bracket, they owe 10%. Look at bubble number three on the range 0 to the first $20,550. So if they owe 10% on that range, the amount that's in the range that they have currently is $20,550. They have income that fills the entire first range. So what's the tax due? It's 10% of $20,550. That's box 2, or bubble 2 times bubble 4, sorry. And that's bubble 5. So they owe $2,055 on the first range. So far, so good? That's the first range. But remember, they earned $350,000. So we're going to do the next bracket, which is 12%. They filled that range as well. So they owed $7,560 from that range. The third bracket is 22%. They filled that range as well, because look at the end of the range, the married filing jointly range. If you look at the biggest number in that range, you can see that they keep filling up those brackets. The last bracket that they filled, the last bracket they didn't fill. That's the 32% tax bracket. Look at bubble number 7. Bubble number 7, and compare that to bubble number 6. So the 32% tax bracket is from $340,101 all the way up to $431,900. They didn't make $431,900, they made $350. So they didn't completely fill that bracket. So how much did they have in that bracket? They had $9,899. That's the only portion of their income that's in the 32% tax bracket. So if you take 32% times $9,899, you get $3,168. So if you add that right tax column completely up, you get bubble number 8. They owe $72,463. But what was the highest tax bracket they were in? 32%. But what was the average tax they paid? Well, if you take that number, $72,463, that's the total taxes they owe, and you divide it by 350,000, that number is 21%. So their average tax bracket or their effective tax bracket is 21%. But the highest tax bracket that they touched was 32%. Does that make sense? So if they earn one more dollar in the business, how is it taxed? It's taxed at 32 cents per dollar. Let me just pause for a minute and see if you have any questions before I go on, because this is a major shift in thinking about how money is taxed in the United States. I don't see any questions coming in, so either you're all asleep or you got this because I described it clearly. Okay. Thanks, Tuba, for your question. So the question that was asked was, if you keep filling up these brackets, how do they subtract? So let's take the first bracket, between $0 and $20,550. How much money is in that range? Well, it's 20,550 minus 0, which is the third column, which is bubble number 4, 20,550. Now let's drop down to the next row, which is the 12% tax bracket. That is 12% is applied to the amount of money that you earn between 20,551 and 83,550. If you take 83,550 minus 20,551, that's the amount that's in the range. And that number is $62,999. And on the amount in that range, you must pay the 12% bracket. So what we're doing is we're incrementally filling the brackets and incrementally paying more taxes as you fill the brackets. Tuba, did that help to explain? So as you move up, you pay more. So you can imagine next year, let's say that this family earns more than $350,000. Let's say they earn $400,000. They will naturally pay more in taxes because they'll have more income in the higher tax brackets. And the federal government keeps changing the tax rates and the tax brackets. That changes every single year. Thanks for Tuba for your question. Any other questions before I go on? We've got about 10 minutes left. Okay. Now that we've calculated the taxes, and the software does this, so you don't need to worry about making mistakes. You look at your payments. Again, there's not likely mistakes here unless you've left something off. So what you want to do to figure out what you've already paid is first look at your paycheck, because you're paying federal taxes through your paycheck as well as you should be doing them through your quarterly estimated tax payments. It's the same federal tax. It's just you're paying it through your paycheck versus through estimated tax. So you want to make sure that all those numbers are captured. You don't want to forget that you paid something. So you want to make sure that you include all your paycheck taxes already withheld, your estimated taxes you've already paid, and carryovers from previous years. This is the most common error. There was one year I forgot to tell my CPA that I paid $12,000 in Q2 as an estimated tax payment. So my taxes were $12,000 higher. So of course, once I caught that error, I had to tell my CPA about it. How does my CPA know what my estimated tax payments are? You got to tell them. They can't read your mind, and it's not reported to them. So you got to tell them. So the most common errors here are that you forgot to tell your CPA about something. The next section is the balance due. This is just math. It's the taxes owed minus the payments. There's no, this is just math. In fact, just so you know, this is kind of a joke to me. The federal tax return, that's Form 1040, most people only have to verify 6 boxes. The rest of it's just math. You don't need to verify the math. Everyone does the math correctly. All the software does the math correctly. Now, if you're doing your tax return by hand, that's a different conversation. So then we got the balance due. What you want to check here is that if you're getting money back, that your bank account numbers are correct. You don't want to transpose your routing number or your account number and give the money to somebody else. So you want to make sure that that's correct. And then finally, we have a signature block at the bottom. That's it. That's the personal tax return. 2 cups of coffee. That's it. 2 cups of coffee, you can review your entire tax return and get it right. And most of the time, if there's a mistake, something was forgotten. So now that you've got your draft return and you reviewed it, all you need to do is sign it and then either pay or get a refund. That part's really simple. Your CPA will give you instructions on exactly how to do that. And then the money shows up in your bank pretty quickly. If you're getting a refund, you can either carry that money forward to next year as a credit, or you can get cash, you can get money. It's your choice which one you want. Just want to mention that if you file something later where you amend your return and the IRS owes you money, you got to wait longer to get the money. And right now the IRS is backed up because they're so busy and COVID is still affecting them. So you want to get your tax return right the first time, because if you file and you're getting money back and you file it with your original return, you'll get your refund quickly, like maybe in a week or two. If you have to do an amendment to get a refund, then you might be waiting a while. And we've been hearing that people are waiting 8 to 12 months to get refunds. It depends on the nature of the refund. So get it right the first time. Now, don't forget, after you file your taxes, you want to save all your files. Save those PDFs. That's what's so great about doing things in PDF. You can put it on, I mean, I wouldn't put it on your hard drive. Save it somewhere like OneDrive or Dropbox or Box, something like that. Save it up to the cloud, because that way your hard drive won't crash and it's safe. So if you ever need it again, you've got it. I used to print my tax returns out and save them in a drawer. I don't do that anymore. All right, so here's what success looks like. If you've been listening and paying attention to this little training, I talk about working cooperatively with your CPA and then reviewing your tax return. So a successful tax return is one that's accurate the first time. It's filed on time, either in April or October, and it's predictable. What that means is that you know what your tax liability is and you're not surprised by the number you get from your CPA. If you find right now you are getting surprised by your tax return, which means you're sitting on the edge of your chair anxious about getting your tax return, then you're not doing tax planning. If you're not doing tax planning, then you want to listen at the end. I'm going to talk about some additional training that you may want to subscribe to so that you can learn how to predict your taxes more accurately. You should not be stressed by filing your taxes. In fact, taxes actually are a scorecard. They tell you how well you're doing. If you view your taxes that way and you know what's coming, they're not scary. In fact, they're very predictable. So these are the 4 things that we try to teach in our business for how people should file their taxes. Now, I just walked you through the personal tax return, and I gave you a boatload of information. You may not be able to remember all of it, and you may not want to come back and watch this video later, which is being recorded. So we've written down all of the steps in a handy dandy little guide. It's free for you and you can request it and we'll email it to you. But there's 2 versions of it. If you earn less than $1 million a year, but more than 25,000, use the QR code on the left side of the screen, because it's got the tax tips in it that are appropriate for the tax return that you need to file. If you earn more than $1 million a year taxable income, visit the QR code on the right. It's got different things in it that are more appropriate for people that earn more than $1 million a year. And by the way, I hope you're earning more than $1 million a year on this call. That would be great. All right, final thing. Here's the key takeaways before we pause for questions. What we talked about today is treat your tax filing like a mini project. It's not adversarial. Your CPA is not responsible to get it correct. You are, which means you need to treat the project like a cooperative team sport. If you've already filed, go back and review your tax return. If you haven't filed, then we recommend you file an extension so that you can have more time to treat this project the way it deserves to be treated. You need to review your tax return as a business owner. If not, you could be very easily overpaying. It should take you about 20 minutes, 2 cups of coffee, and they should both be hot by the time you finish them. And then finally, your tax return is a scorecard. And we talk about the family office. If you look at the graphic on the right, these are all the parts of your family finances that you need to manage when you're a business owner. This is what we teach. Your tax return is just one of those elements. Actually, we don't even teach tax returns. We teach tax mitigation and tax strategies. Your tax return is actually a scorecard for how well you've implemented tax strategies in your business and your family. And we look at the percentage tax rate you're at, and we figure out how to get that down over time to reduce tax drag long-term on the business. So this is what we've talked about today in our training. Now, you're welcome to, I'm going to pause here in a minute and take questions. And then if you stick around for another couple of minutes, Well, if you like this training today, we'll give you an idea of how to get more training like it. But before I do that, I want to answer any and all questions that people may have. Please put them in chat, and please select everyone so that everybody can benefit from your questions. I'll give another couple of moments, and then we will proceed. I don't see anybody typing any questions. If anything comes to mind, feel free to drop it in there. All right. I want to just tell you briefly that the training today, if you like it, there's something that we do in our family office that we train business owners how to live more abundantly by managing the finances that come out of the business. The primary thing we teach is how to get the right advisor team, which is how do you get a CPA that can actually take care of you and do the things for you that you need. Also, how do you protect your business? You've put a lot of money and time into it. How do you protect it from people that maybe want to protect your taxes so you don't overpay taxes? Also protect it from litigation and things like that. And how do you get confidence in things like reviewing tax returns, getting the right entity structure, protecting yourself with the right amount of life insurance? We actually don't sell any of those specific services. We provide the training. So this is the training that we provide. It's a 12-month curriculum. I'll disappear here for a second. These are all the topics. What you experience today is a little bit of the training in March. It's much longer than this, but we provide the training and the content, the templates, the guides, all the things to learn all of these topics. And this is called the ARK Academy, designed for business owners. If this is something that you're interested in, here's where you can get more information. Like today, you probably might be sitting there being like, man, I wish I would have known this stuff earlier. How many years have I been filing and I haven't been checking my taxes? That's the first comment. Where have you been? The second thing that people tell us is, well, how come no one told me this before? Things like how to save on taxes. Your CPA is there to make sure that you fill out the forms properly. They may know how to help you a little bit with tax mitigation, but most of the good, juicy tax strategies, CPAs don't know. So we teach that to business owners so that they can save money on taxes. And then the last thing is that, as you notice, I'm not a CPA, I'm not an attorney, I'm not even a financial planner, and I'm not here to sell you anything. All I can do is educate you. So we're here to help business owners. I am a business owner myself, and so that's why we do this. Is the coaches are business owners that teach these topics. So things that we learn, it's our methodology. If you want to learn more, down in the corner is a QR code where you can sign up for our early access program. We're launching another academy in July or August, and so we'll be reaching out to people that want to join to learn more then, if you'd like more. So this wraps up what we covered. I hope you got a lot out of this today, and I hope you find that this is not only refreshing, but that it's helped you get some money back on your tax return.